Welcome, everybody. Welcome to today's conference here. I'm building a bulletproof business, which obviously all of us are in a crazy time as small business owners, but we're going to get out of it. We're going to get through it, and then we have to do something differently in our business. And so what I'm going to share with you today in about 30 minutes or so is exactly what I find will help you to become bulletproof once things start turning the corner and you start rebuilding your business if you've been affected. And I'm going to give you some very specific key things to make sure you have something to write with and take some notes down to apply it to your business. And then we'll talk about a way that you and I can talk and one-on-one and go through that and apply it to your business as we go through here. A little bit about me. I've been doing this for 20 years. I coached well over 1,000 businesses during that time in a variety of industries. And I'm also the best-selling author of the Amazon book, The 80-20 Business, Big Results from Small Changes. And my program is called 80-20 Business Coaching, where I apply these principles specifically to the businesses based on where they're at. In today's session, and as I go through this, if you have questions, type in your questions, and then at the end, there'll be plenty of time for me to answer them. But today, we're going to talk about three distinct areas. We're going to talk about financial benchmarks. We're going to talk about organizational action plans that you need to take. And then we're going to do a little marketing one-on-one and then talk about that as well and get through some of that. So Financials 101 is the first thing. And, I realize you probably don't have an accounting background, but I'm going to teach you how to read your financials in a way that it's going to make it pretty darn easy for you. And we're going to talk about how you can understand the three key reports that your financials have, you should be getting every month. And I'm going to teach you how to read the signals real quickly and understand what actions to take more importantly. But again, I'm doing this assuming you don't have an accounting background, so it won't be over complicated. I use a very simple system: red light, yellow light, green light, and that's an important part of this process. Red light, yellow light, green light. Everything I do as I go through this will be that way. So the first key thing that you should be looking at the end of every month is the balance sheet. Your balance sheet is literally your scoreboard, period. It's literally your scoreboard, and it tells you whether you're winning or losing the business ball game. And it can apply to any sport that you wish. If you looked at it as a football game, this balance sheet would tell you if you're up or down, how many touchdowns you're up, how many touchdowns you're down. It will tell you how many minutes are left in the ball game. And it will tell you how close to the end zone you are or how close your opponent is to scoring. It tells you a whole bunch of stuff that you can relate to sports very, very quickly, which we, again, also hope we get back to very soon. But at a very simple level, on one side of the balance sheet, you have the assets, which are the things you get to keep, the good stuff, cash and cash equivalents. On the right, you have liabilities plus owner's equity, and that is what makes it all balanced. And that's an important part of this process is the balance. So let's take a look at that, and let's dig a tiny bit deeper into this because most people don't pay attention to this. In your balance sheet, there are current and non-current portions, period. And you have this of both current assets as well as current liabilities. Now, the thing that makes them current or not is 12 months. Anything that happens in the next 12 months, either in the asset or liability column, is considered to be current. And let me give you some examples. Cash in the bank, anything that's expected to convert to cash in the bank within 12 months is a current asset, such as accounts receivables if your business has them. If you have inventory, you're going to convert it into cash in 12 months, that's current. When we talk about the liabilities, it's a little bit different. You have your payables because you're going to pay them out. Cash is going to leave the business within 12 months. And then monthly note payments. So if you had a $500 a month note, your 12-month portion of that current liability would be 500 times 12, which is $6,000. That's how much would be in the current liabilities portion. Everything beyond 12 months would be non-current, and it would continue to be that way until you get into the last 12 months, and then you would see this go 6,000, 5,500, 5,000, 4,500 until it went down to zero. So that's the point of all that. But my real point in all this is to explain what we're using this for. Here's a sample balance sheet. In this sample, we take $175,000 of current assets, we take $140,000 of current liabilities, and we divide them together. And that gives us what is called a current ratio, period. And that's a very key number for running your business. And that's something you should look at the end of every month. You should look at your current ratio and see what it is. But take a look at it compared to this scale. What I've learned over the 20 years of working with business owners is if that ratio is 2.5 or higher, you are bulletproof. You're not going to go out of business even in times like this. If it's 2.4 to 2.9, they're cautionary, and less than 1.9, that can be red. And again, these numbers are your strength numbers. This, a 2.5 or higher is you're up by 5 touchdowns with 1 minute left in the ball game. A 1.9 or less is you're behind by 5 touchdowns with 1 minute left in the ball game. So it really just depends on what you're doing here. But the point being, this is how you measure your business every month. You should be at the end of the month. You should be pulling these numbers out, pulling that balance sheet out, and taking a look at your ratio. Okay, so the key question is, how do you get to the 2.5? Well, you do that with cash, and that's an important part of this process. But here's another indicator for you. Cash on hand is important. We're seeing it in real time right now with all of this craziness going on. But here's another number you need to take a look at. Take a look at your average daily sales, and then let's say they're $1,000 a day, and you had $20,000 in the bank. You would have 20 days cash on hand. Very simple. There are many ways to do this that can be complex, but that's a very simple way. Just do it like that. But how much should you have? Well, here's what you should have if you want to be bulletproof. If you want to be bulletproof, you should have about 45 days cash on hand. That will get you through the next crazy time like that. And, hopefully we never get to see this again in our lifetime, but still, we want to be bulletproof. 30 to 44, that starts to become a little cautionary. And then, of course, less than 30 is red. And so this is where these are two numbers. Your current ratio and your days cash on hand are two numbers you should be looking at the end of every month, all the time, and building up to. And if you're a business that has accounts receivable, obviously you want to keep that under 30. When it comes 31 to 45, it gets a little cautionary, and greater than 45 is a red light situation because it takes out your cash flow, and that's not a good thing. So that's another indicator if you have accounts receivable, if you're that type of business. So here's some rules to live by. You're only as strong as your lowest rating, period. So if you're red in 1 and green in 2, you're red. It should be the first statement you review at the end of every month. And then you make all cash decisions based on that rating. You decide whether you're going to buy something, you decide whether you're going to expand, you decide whether you're going to hire, all of those things based on that rating. And that's an important thing. Now, here's the next question. Let's say our rating's not a 2.5. Let's say we don't have 45 days cash on hand. How do we get there? Well, that comes from the profit and loss statement. And the profit and loss statement is probably what we all look at, but sales minus your cost of goods sold, the materials necessary to produce what it is you do, wages, but not owner's wages. I highly encourage you to remove owner wages from this equation, and I'll show you why in a second. Then, of course, you have your overhead, which are all your fixed expenses that you use, and then you're left with your net income. Now, here's where it gets tricky, and here's what I want to drill into your head. Net income is not profit. And I'll say it again. Net income is not profit. Net income is what your accountant looks at and says, congratulations, Aaron. Congratulations, Bob. You made a lot of money. And you look at your accountant and go, okay, well, where's it at? Because it's not in my bank account. And that's the biggest misconception that we have. Now, this is the number you're going to pay your taxes on, but it is not income that you get to take home. Here's what you get to take home. And this is why I removed owner's wages from it. The third statement, which most people have never seen, but you should, is the cash flow statement. And that starts with net income. You add back depreciation, amortization, interest, and then you take out note payments. And then you're left with your true cash flow. You see, these note payments outside of leases never showed up anywhere in your profit and loss statement. So it only shows up on your cash flow statement. So that's where the difference between net income and cash flow happen. And the cash flow is what you as the owner get to live on, not the net income. And let me show you a great example. This sample company at the end of the year had $23,000 in net income. Looks like they are really doing okay. And the accountant said, hey, you have $23,000. And they say, okay, where's the cash go? Well, If you go down through this document and you start looking, everything with a bracket on it is money leaving the business. So at first they had about 21,000 left the business for investing activities, another 3,000 for financing activities. Well, lo and behold, at the end of it, they only increased their cash position that year by $1,000. So the cash at the end of the year was 2,200, not 23,000. Big difference. The problem is many business owners will start spending that 23,000 because it looks good, and they get themselves in trouble really, really quickly. So I encourage you to take a look at that statement as well. And if you want me to do one for you, just contact me and at the toddknuckles.com/talk. Just schedule an appointment, and I'll be happy to work one of those out with you. To review, your balance sheet should be looked at first every month, red, green, or yellow. That's the most important thing. Then remember this, if you remember nothing else, your net income is not your profit, period. So don't spend it all. And then cash flow is king. That's how we get out of this. That's how we turn this into a bulletproof business. And so if your current ratio is down, if your days cash on hand is down, when you take a look at your cash flow, decide how much you can put back into your business, back into the bank to strengthen your business before you start taking money out. And that's how we do this. And of course, what I recommend you do, which I do with all my clients, is create a cash flow budget and plan to spend your money going forward. So that's, in a nutshell, is Financials 101 and the key points that I want you to apply to your business. So let's move on to the second thing that will help make your business bulletproof, and that is organization, because this is why you can't increase sales under normal conditions. And I'm going to explain this to you. So the goals for this session are to teach you how to organize so you can grow, because that's important. You can't grow without organization in place first. You cannot grow above a weak organization. I want you to understand the functions that all businesses should have in place, and I'm going to teach you really quickly how you can lead a little bit better as a leader. And leading through these traumatic times right now are important to get to the other side and become bulletproof. So let me show you this chart. Now, I realize everybody's business is down right now, so don't apply this to your business today, but apply this to your business last year. And if you plotted your sales on a chart last year and it was a lot of this, it's not a sales problem. That's an important thing to understand. This is the first telltale sign for me that a company, it's not a sales problem. So take a look at your last year, plot it on a chart, and see if it looked more like this. This is an organizational issue. And the reason is because what happens is you get out like in January and you started selling like heck and sales went up, and then, we don't have the organizational structure in place to handle that. And so, boom, we have to stop selling, and then everything crashes in February. And then we get slow, so we sell in March, and then we get so busy that, boom, we have to come back in and do it. So fix your organization before you start fixing your sales problem is a key thing for business owners to understand. And you have two choices. You can organize around people, or you can organize around functions. I highly recommend you organize around functions, not people. And the problem with especially small businesses, we get really dependent on people and their unique skill sets, and we start building our business around that, which is a very big threat, because if that person leaves or we have to get rid of them because of attitude or whatever, we're in trouble, because it's going to be very difficult to replace that person. So follow with me here and try to apply this to your business right now. I recommend you organize your business around functions. And every business in the world, I don't care if you're IBM or you're a pet shop, you have four basic functions. You have the owner, the general manager, typically the person that started the business. You have an operations manager, sometimes called a production manager. You have a sales or sales manager, and then you have a finance or finance manager. Now, in a small business, you could have one person doing several of the functions, and that's okay. But the functions are the functions. And anytime somebody leaves, you can plug somebody back into that function, no matter who they are. And that's an important part of that. For the owner or the general manager, you have some key responsibilities. You are ultimately responsible for everything that goes on in your business. You have financial strength and hiring and firing and you name it. But your job is to get the right people on the bus, as Jim Collins says, and get them in the right seats. And then your job is to create the circle of safety, which is a principle by Simon Sinek that I'll go over with you. And then finally, your job is to get your financials to green light and dig yourself out of this and get it to green light as quickly as possible and make good decisions about doing that. To your next level person manager is the operations manager, and their job is to uphold all the standards of the company, the things you would do if you were sitting in their seat and operating. Their job is to make sure the staff is trained. Their job is to hire, often with the owner on there, and to discipline workers as necessary. And they are literally the owner's right hand. They are the person who takes work off your plate. Typically when businesses grow, it's just the owner and maybe somebody else, and you're growing and growing, and you get to a point where you're overwhelmed as an owner, and that's where you would assign duties to an operations manager to take some work off your plate so you can go out and do other things. So this is a very key position. If you find a good operations manager and get them in place, this can totally change your business. The other function is sales, and a sales manager, and it's someone that will execute a weekly sales plan, as simple as that. And that's an important thing. Often in small businesses, this is the owner. The vast majority of businesses I work with, it's the owner is the key salesperson. And, it's very simple. The job is to drive more revenue. It's not any more difficult than that. And if you have salespeople, the sales manager would manage those salespeople and give them a plan and make sure that they follow up on their plan. So that's the third function that every business must have. And the last function is finance. Typically in small businesses, especially $1 million or less, this is part-time. I've even seen it in $2 or $3 million or less companies where it's part-time, 20 hours a week maybe. And maybe it's a trusted family member, very common. And they prepare things for the CPA at the end of the day, and their job is to keep up with that and keep the books clean and do that. And so that's another function that needs to be in your business, no matter what your business is. It's just 4 functions. That's all you have to fill. And so take a look at your business, write out those 4 functions, see if you have a person to fill those functions, make sure you give them tools to do their function. That's an important thing. And then allow people to do their job. That's an important thing. It's that is, if you're a small business owner and you start growing your business, it's really tough when you see people not doing it 100% the way you do it. Well, if they do it at least 80% as well as you do it, get out of their way. You can mold them later, but don't try to nitpick everything. For selling owners, what keeps you from selling, and what can you do about that? Who can handle the tasks? Who can you hand things off to so that you can get out and sell more? Because at least if you're a selling owner, at least 20 hours of your week should be spent selling. I know the other 20 is going to be on general management type tasks, but you should be selling at least half that time. And if you can't, then why not? And figure that out. An important thing that you have to understand is whether you are a leader or whether you are a manager, each one of you has a great opportunity right now to become the next level leader, a bulletproof leader, somebody that inspires your staff, somebody that leads your staff forward. And, at the end of the day, no one wakes up in the morning to go to work with the hope that someone will manage us. We wake up in the morning to go to work with the hope that someone will lead us. And leading is completely different. We've all had great leaders in our life and poor leaders in our life. And it's important to think about what made the great ones great and what made the weak ones weak. And that's an important thing as well. No organization in a crisis is managed out of it. It is always led out of a crisis. And so right now it's your job to lead these staff members out of this crisis, out of this challenge, and do that and get out of that plan. The common misconception with leadership is we often think the leader should be the first person to cross the finish line. And that is not really what happens. A leader, actually, their job is to get as many people involved as we all head together towards the finish line, period. That's your job as a leader, is to get your troops together and get everybody going and move towards the common goal. And that's an important thing. And then your other job, as Simon Sinek points out, is to create what's called a circle of safety. The circle of safety is your company. And there are dangers from the outside, from customers. There are dangers from the inside, from individual workers. And individual workers can disrupt this circle of safety. And when the safety is disrupted by threats, and this is a problem. And I often say workers, it's like workers getting the flu. Just like you get the flu and you feel bad, the same thing happens when that circle of safety is disrupted. So when there is danger from outside or inside your organization, workers start getting low energy. They get less attentive to detail. They become less efficient. They start going through the motions just like you would if you were sick with the flu right now, and they do just enough. That's an important thing. And that is where you start seeing a lot of worker churn, workers leaving. If you look over the last couple of years and you've seen you having to replace staff a lot, you have a disrupted circle of safety that you have to fix. And unfortunately, that's an important part of it. And, again, we're under strange times now, but look back over prior to all of this happening and think about, did any of your workers have the flu? Were any of your workers just going through the motions because they just weren't happy there, and your circle of safety is disrupted? That's an important thing to think about and fix. Now, I will tell you, many times internal disruptions are caused by a team member that is quote unquote an all-star, and we just can't live without them. Well, you're going to have to do something about that. And that's probably your biggest challenge. I find that to be very, very common with everything. And just really just identify what could possibly be doing that. Moving forward, once we get through this crazy time and we start building our organization back, pay attention to this and make sure that it's there. When workers are safe, when they're in that circle of safety, they thrive. They enjoy working as a team. The business then thrives and more gets done. And that's an important part of that process. So we've talked about the financial things to look for. We've talked about the organizational things to look for. And then now I want to give you just a quick sales 101, because now we're in a position where we can grow sales. And that's an important part of this process. So you can only grow sales when you have the organizational structure in place. Remember the chart I showed you. So what we're going to talk about are two key things, which is finding your 5% and then choosing your marketing path, really, is what we're doing there. At the end of the day, not all customers matter. They just don't. Just the perfect ones matter. Those are the ones that are going to bring you more money than before and help you to focus your efforts. I wrote my entire book based on this principle right here. It's not the 80-20. It's the 80-20 within the 20%, and you'll see how that translates out. And mathematically, what you'll find is that gives you about 5%, giving you about 50% of your results, good or bad. And so in your business, if you're a B2B business, you'll probably find that about 50% of your business comes from about 5% of your customer base, give or take. If you're a B2C business, you will find that about 50% of your business comes from 5% of a certain demographic. That's the difference in B2C. And so you have to sell to who it is you are best at. So I recommend that everybody defines their customers in as much detail as possible. Again, if you're a B2B business and you might sell multiple products, you look back at your 2019, let the past guide you. Look back at your 2019. What type of customers did you sell to? Define it as much as you can. What products did you sell to them? Define it as much as you can. If you're a B2C business, you need to define your demographic. Are they married or single? Are they men or women? Do they have kids? What do they drive? Where do they live? Anything you can do, and you can really, you're building your perfect customer avatar based on the past and who has bought up to now. Then you can put your marketing dollars almost in a disproportionate way at that target perfect customer and that perfect customer avatar. And that's an important thing to do. And then now you can do it's like rifle-based marketing versus shotgun-based marketing. And that's an important thing to do because you save a lot more dollars and you get much, much better results. And if you need for me to help you through that, just you go to that link at the bottom of the screen there. Marketing matters. And there are many different types of marketing. Once you have come up with your perfect customer avatar, there are many ways to go after them. Digital marketing works great for some. Direct mail still works great. Television, of course, sometimes newspaper. In my program, we do a scorpion marketing message to target your perfect customer avatar. So it just depends on what works well for you. And try it. And again, look at the past. What's worked well in the past, and now let's just take what's worked well and focus it on our perfect customer avatar, and you're going to 10 times your business pretty quickly with what you do. To review, who is your perfect customer? I recommend during these times you take time to define who your perfect customer is. What is the best marketing path you're going to use once we get through this little hiccup that we're all in right now? And how will you begin? What do you do first, second, or third to get things moving with your business? I really appreciate you taking some time today and all of this. If you want to talk to me one-on-one, just schedule an appointment at this link right here, toddknuckles.com/talk.